This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, getting into the week, getting into the thick of things. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Morning,
Hi,
Nigel.
morning.
Well, looks like we have some ammunition today for the Bulls, right? HDFC Bank's numbers not bad, guidance is good. Even the global markets were not too bad.
Well, that's right. You know, HDFC Bank, that's going to be the key stock from here. Will it stop underperforming from here? I think that's the key question, right? Outperformance, I think that's secondary. But will it stop underperforming is going to be important. And otherwise, things were looking good. But only that Biden visit tomorrow. So I think the markets will wait to watch out for what happens on that front.
We were saying this yesterday, right? At the margin, I mean, it's such a twisted, complex situation, but at the margin, the fact that the US is getting involved diplomatically to try and contain the conflicts from spiraling out of control is perhaps a little bit positive, because the risk is that, I mean, other countries get involved and it becomes a bit of a proxy fight. So in that sense, I think it is positive, and it was showing through in yields, etc. yesterday overnight. Well, let's just quickly tell you what you need to know as we start another sort of trading session. We'll begin where we left off yesterday. Yesterday was absolutely flat. I mean, and it got flatter by the time we actually ended. Even the mid and small cap part of the market, which was up 0.25%, 0.75%, I mean, they had very little left to show by 3:30. On the index, of course, nothing at all. But overnight, the environment is risk on, right? I mean, US indices have done well, and not just the S&P, the Nasdaq is up. That's been the one which has been under pressure. But you also have the small cap index, which is extremely under pressure. The Russell 2000, which went up actually even more, 1.5% plus. Yields have rebounded, right? Now, you have to look at what yields are doing, and higher interest rates mean a certain set of outcomes. Lower market interest rates mean a certain other set of outcome. The driving force for yields to actually sell off, and we said this yesterday, that yields last week, Friday to Friday, were down almost 20 basis points. The narrative has been about what the Fed itself is saying, that market rates have gone up so much that they don't need to do very much in terms of interest rates. So it's that. But this also very clearly demonstrates risk sentiment, right? Bond prices coming off, yields going up. And that basically is a risk-on environment. And that largely at the margin over the last couple of days has also started to be influenced by geopolitics. Dollar index, that's the other one, right? I mean, money going into the dollar is risk aversion. Of course, it can mean other things as well. But for now, that's essentially, how this is looking. And dollar coming down is maybe a little bit at the margin. People becoming a little more comfortable taking on some risk, especially in things like equities, etc. Oil prices, they're still holding a tad above the $90 a barrel mark. So not very much by a change there. It was down slightly, but still above 90. Now, how does all of this tie into the market here? The Nifty is still above the 20-day moving average, but by only a whisker. 17,716 is the 20-day moving average. We left off about 15, 16 points above that particular level. So that's got to be defended. First up, no question about that. The rising trend line from the bottom now is near about 19,710. Again, around the 20-day moving average. So hopefully there's a cluster of support, if the need be, that's going to be supported. But the big one is the 40-day exponential moving average, which is a little lower. Again, not very far away, but that's 19,640. And that's a support which should not be broken if, this market eventually, after all of this confusion and up and down and not very much by way of actual price move to show for it, has to resolve higher. So that's the level which should not be broken on the downside. Nifty Bank did not close positive. It failed to confirm a higher low in trade yesterday. And the Nifty Bank has been clearly the weaker. It's actually lagging behind the Nifty in a very, very substantial way. And hopefully it'll pick up. So far, it's not. Now, the Nifty Bank needs to first cross the 20-day moving average, which stands at 44,714. Again, not very far away from where we are, about 1% or so. On the downside, it should not break levels of 44,044 and 43,900. 44,400 is low. Yesterday's low. 43,900 is the recent low around where the market has found support. So these are levels to work with. Hopefully, and I said this yesterday as well, things at the margin looking a little more constructive. So let's watch this space. the intensity of market reaction to known events also starts to fade. And we've seen this over and over and over time the intensity the market does not react in a very, very sharp, vicious way to the second or the third time to the same event as compared to when it's a surprise. So that's the other thing to watch out for. 64 points higher. Hopefully, we're able to build on that with those levels in mind. I think I would say perhaps in a very small way, you can dip your feet in, see what prices want to do from here. Sonia.
Oh, absolutely. There is a lot of ammunition today for the bulls. So, in that context, it's going to be a good start. And perhaps we could even build on to our gains. Because as I said, the bulls have a lot of ammunition. Let's start first with the biggest skew, right? HDFC Bank. And I liked what I saw with HDFC Bank's numbers yesterday. There was a rebound in terms of loan growth. The asset quality was steady. The guidance from the management was quite bullish as well. Post the merger, the pro forma loan growth was about 5% quarter on quarter. Sequentially, it's a 5% loan growth compared to a 1% loan growth that we saw in the preceding quarter. So in that context, loan growth has picked up. The company said that the bank is poised to deliver strong growth going ahead. They will maintain the ROA between 1.9 to 2.1% levels. And remember, we went into the earnings with very low expectations. There's been a big underperformance in the stock as well. So that will be the driving force of the market this morning, in all likelihood. The other thing to watch is Bajaj Finance. The earnings today will be closely watched out for. So that's another heavyweight that the street will keep their eye on. But apart from that, the Nifty will not only get support from HDFC Bank today, it will also get support from global cues. The Dow was up over 300 points overnight. There was also large buying from domestic institutions in our own market. So DI has bought about 1,200 crores in the cash markets, while FI has sold less than about 600 odd crores. As I said, the US markets ended with very good gains. So that's another thing the bulls will latch on to. A lot of big numbers coming out later today. There's Bank of America, Goldman Sachs that will be reporting their numbers. There's retail sales, industrial production data for September that comes out today as well. The only thing on the margin you'd want to watch out for is what's happening with the currency, because yesterday the rupee hit a new low. It hit 83.28 because of crude fears, geopolitical tensions, etc. So just watch out for what's happening with the currency. Otherwise, the equity markets have actually been stable. The market has been building on to its gains, and this morning, definitely, there is some ammunition for the bulls.
Well, that's right. The GIFT Nifty is suggesting that we're likely to see a 60-70 point gap up, but we need to build on to those gains because that's what could lead to a big short covering bounce as well. So the 70-point gap up, it's encouraging, but building onto that is going to be something that the bulls will track. HDFC Bank, year to date, that's been a bit of an underperformer. Going by the numbers, going by the commentary as well, can it give up its underperformance? That's going to be important. And I think it has the ingredients out there. Because year to date, it's underperformed by more than 15%. And now with these numbers, you'll at least expect it to be a market performer, if not an outperformer. So HDFC Bank will bat for the bulls. And overnight as well, the ADR was higher. So that's what supports its case. The Nifty Financial Services Index, well, that plays out expiry. So that's going to be another moving part for the second half of trade. Just a quick point on cash market volumes yesterday. They were extremely tepid. If you're looking at the gross volumes from both FIs and DIs, well, they were 20 to 25% lower in comparison to the average that we've seen in October itself. So that's one data point. The other factor is the Nifty 50 stocks, the traded volume out there was less than 15,000 crores. The last time we saw such low volumes on the Nifty 50 stocks was near New Year, Jan 2nd, Jan 3rd. So that's telling you the kind of volumes that he had, extremely tepid volumes. Participation was extremely low yesterday. So I'd like to see more of a recovery today in terms of participation, particularly on the Nifty 50 stocks. Positioning, well, the FIs, they lightened positions both on the long as well as on the short side. And now 73% of their positions are on the short side. Moving to the options data. Now the 19,750 call and the 19,800 call, you punch in those premiums out there. The 19,830, 19,850. That's the resistance zone for me. And on the downside, there was some writing being seen at around 19,700 put, which brings us to the levels. 20 and 50 DMA, important support zones. Near term, 20 DMA is important. On the upside, we went nearly to 19,850 and we did a U-turn from there. So that's important. And the Nifty Financial Services Index. Well, that's the one that plays out expiry today. It's trading pat in line, in the middle of both those two strikes that have come up for you on the screen at around that 19,800. So the broad range should come up for you around a 250-point range. It's likely to expire in this particular range. Unless it breaks, either which ways, either higher or lower, then we could see a bigger move. So the GIFT Nifty suggests a gap up. HDFC stock, that's the one, HDFC Bank, that's the one that the bulls are banking on. We need to build onto those gains.
Absolutely. And, you know, as we were mentioning, the rupee has been hitting new lows. So 83.28 is where the rupee closed yesterday. So it would be interesting to get some views on that as well this morning. Abhishek Goenka of IFA Global says the rupee has been under pressure as Brent has popped above $90 a barrel again, and FPI selling in domestic equities has continued into October. There's circumspection now on account of uncertainty around how the Israel-Hamas war will unfold, and this is fueling the dollar strength. Given these dynamics, he expects the rupee to remain under pressure over the short term, but to trade in a range of 82.40 to 83.70 over the medium term.
On bonds, we've got views coming in from Abhishek Goenka of IFA Global, who says that rising yields and volatile rates in the US have been influencing domestic rates. Lower than expected inflation print failed to fuel a rally, and people are generally confused as to how long rates will remain high. Upcoming GDL auction is likely to sail well, but at a bit elevated levels. In absence of any cues, he expects a 10-year here to be between 7.32 to 7.38%.
Right.